Assalamualaikum warahmatullahi wabarakatuh. So in this project, we compare two of Malaysia's leading retail chains. First of all is 7-Eleven and the second one is 99 Speedmart Retail using financial ratio analysis. Although both operate nationwide, they have very different business models. 7-Eleven focus on convenience, offering 24-hour service and higher margin products, while 99 Speedmart operates as a neighborhood mini market, selling everyday household essentials with a high volume, low margin strategy. By analyzing their liquidity, profitability, efficiency, and solvency ratios, we aim to understand how these different approaches affect their financial performance, resilience, and long term sustainability.
Assalamualaikum and greetings everyone. My name is Wandina Ashraf. Today we are going to look at a brief but critical financial comparison between two major retail players, 7-Eleven and 99 Speedmart, focusing specifically on their short-term financial health. Before we look at the data, let's establish our baseline metric. We are using the current ratio. This ratio simply measures a company's ability to pay off its short-term debt with its short-term asset. In conclusion, the higher the number, the safer the safety cushion. When we place the two companies side by side, a clear gap emerged. 7-Eleven operates with a current ratio of 1.06 times. In contrast, 99 Speedmart sits notably higher at 1.55 times. What does this mean in practical everyday terms? For 7-Eleven, they hold just RM1.06 in assets for every RM1 of debt. This is a very tight margin with little room for error. 99 Speedmart, however, holds RM1.55 for every RM1 of debt, which provide a much more comfortable and flexible liquidity cushion. To conclude our comparison, based on the current ratio, 99 Speedmart possess a definitively stronger and safer short-term liquidity position compared to 7-Eleven. However, to truly understand liquidity, we must look at a stricter test, the quick ratio. This metric is calculated by stripping inventory out of current assets. It reveals a company's ability to meet immediate obligations without being forced to sell off unsold stock. The ideal benchmark here is a 1.0 or higher. Looking at the quick ratio paints a dramatically different picture. When we remove inventory from the equation, 7-Eleven drops into a deficit of negative 0.24 times. Meanwhile, 99 Speedmart remains positive at 0.71 times. What does this data tell us? For 7-Eleven, that negative value reveals that they will face severe liquidity issues if they cannot rely on constantly moving their inventory. Their day-to-day operations are heavily dependent on immediate stock turnover. 99 Speedmart with a ratio of 0.71 times has RM 0.71 in highly liquid assets to cover every RM1 of their liability. They aren't fully covering their debt with cash alone, but they are significantly less reliant on liquidating stock compared to 7-Eleven. To wrap up our analysis, although both retail chains technically fall below the ideal 1.0 mark for the stringent quick ratio, our final verdict is clear. 99 Speedmart is in a much more stable and secure financial position compared to 7-Eleven's critical liquidity deficit.
Next, I will be talking about the profitability part. So let's look at the net profit margin, which highlights how efficiently these two companies convert their revenue into actual profit. First, we have 7-Eleven. Their net profit margin stands at just 0.98%. To put that into perspective, for every 1 ringgit of sales they bring in, they only retain roughly 1 cent as net profit. On the other hand, 99 Speedmart shows a significantly stronger performance at 5.31%. This means that for every 1 ringgit of sales, they successfully generate 5.3 cents in net profit. When we compare the two, the conclusion is clear. 99 Speedmart is far more efficient at controlling its overall operating expenses and maximizing profitability compared to 7-Eleven. Moving on, let's analyze the gross profit margin, which shows how much profit each company retains after accounting for the direct cost of goods sold. Interestingly, the table stand here. 7-Eleven commands a high gross profit margin of 30.82%. This indicates a substantial markup and an excellent ability to retain profit immediately after product cost. In contrast, 99 Speedmart's margin is lower at 19.47%. This is relatively standard for mini marts that rely on a high volume, affordable pricing strategy to attract budget conscious customers. In comparison, 7-Eleven holds a distinct advantage in its product pricing strategy and basic control over 99 Speedmart.
We will look at return on asset. This metric measures how effectively a company management is utilizing its asset to generate profit. As illustrated, 7-Eleven records a relatively low ROA of 1.71%, which suggests that their efficiency in utilizing assets is quite weak. Conversely, 99 Speedmart demonstrate an excellent ROA at 14.64%. This indicates that 99 Speedmart's assets are working optimally to generate lucrative returns, making them significantly more effective at asset utilization compared to 7-Eleven. We will go through the return on capital employed. This figure reflects how efficiently a company uses its invested capital to generate returns. 7-Eleven records a moderate ROCE of 7.25%, meaning they generate a moderate return for every unit of capital invested. On the other hand, 99 Speedmart posts a robust and healthy figure of 14.15%. To put this into perspective, 99 Speedmart is almost twice as efficient as 7-Eleven at generating return from its capital investment. This clearly demonstrates that 99 Speedmart provides a significantly higher return on invested capital for its investor.
Now we will talking about inventory turnover. To simply put it, inventory turnover measures how many times a business completely sells and replaces its stock of goods over a given year. Take a look at the chart. 7-Eleven has an inventory turnover of 5.34 times a year, showing a steady but moderate movement of goods. On the flip side, 99 Speedmart clears out and replenishes its stock much more rapidly at 7.29 times a year. What does this mean? Goods at 99 Speedmart are selling noticeably faster. This higher rate indicates that 99 Speedmart has a stronger sales velocity, higher customer demand, or simply more efficient inventory management than 7-Eleven. Now we will continue on average collection period. Average collection period represents the average number of days it takes a company to claim and collect own cash from its debtors. Looking at the data, we see a massive gap. 7-Eleven takes an average of 46.59 days to collect its debts. Meanwhile, 99 Speedmart takes just 8.09 days, showcasing a highly aggressive and efficient debt collection cycle. The clear takeaway here, the 99 Speedmart cash collection management is vastly faster and more efficient compared to 7-Eleven. By turning own money into actual cash in just over a week, they ensure much quicker access to their working capital. Lastly, for efficiency, we'll be talking about total asset turnover. What is the total asset turnover? To put it simply, it shows how efficiently a business uses its assets, like stores, inventory, and equipment, to generate sales revenue. Looking at the chart, 7-Eleven has turnover ratio of 1.74. This means every 1 ringgit of assets they hold generates 1.74 ringgit in sales. 99 Speedmart, however, sits noticeably higher at 2.76, successfully generating 2.76 ringgit in sales for every 1 ringgit of assets. The comparison here is clear. 99 Speedmart is doing a better job of optimizing its total asset size to produce a larger sales volume compared to 7-Eleven. Ultimately, this means 99 Speedmart is squeezing more value and revenue out of the investments they made. That's all for efficiency. Now we're talking about leverage.
Next, I will explain the debt ratio comparison between 7-Eleven and 99 Speedmart. First, for 7-Eleven, the debt ratio is recorded 26.54%. This means that only one quarter the company's total assets financed through debt, while the remaining portion is supported by other sources such as shareholders' equity. On the other hand, 99 Speedmart has a higher debt ratio of 59.47%. This indicates that more than half of the company's total assets are funded by debt.
Therefore, the company has a higher dependence on external financing. Based on comparison, 7-Eleven appears to have a lower financial risk because it relies less on debt compared to 99 Speedmart. Moving on to the debt to equity ratio. For 7-Eleven, the debt to equity ratio is 36.13%. This shows that the company has a stronger reliance on shareholders' equity compared to external debt. In other words, the company's capital structure is more balanced and supported mainly by internal financing. Meanwhile, Nine Speedmart recorded a much higher debt to equity of 146.74%. This means that the company's debt level is significantly higher than the amount of equities invested by shareholders. From this comparison, 7-Eleven has a safer capital structure for long-term sustainability. In contrast, Nine Speedmart face higher financial risk because excessive dependence on debt may increase the pressure of repayment and interest obligation. Lastly, I will explain the times interest earn ratio, which measure a company's ability to pay its interest expense using operating income. For 7-Eleven, the ratio is 1.58 times, meaning the company generates enough operating income to cover its interest expense about 1.5 times. This shows it is able to meet its interest payment, although the safety margin is relatively small. In comparison, Nine Speedmart recorded negative 3.08 times, indicating that the company is operating at a loss and cannot generate enough operating income to cover its interest expense. Overall, 7-Eleven is in a stronger financial position while 99 Speedmart face higher financial risk due to its inability to cover interest payment from operating profits.
Let's look at the final conclusion of our comparative analysis between two of Malaysia's retail giants, 99 Speedmart and 7-Eleven Malaysia. While both brands hold a massive presence across the nation, the operational frameworks and financial strategy present two completely contrasting business models. Let's look at their core pillars side by side to see exactly where they differ. First, regarding their market approach and margins, 99 Speedmart focus heavily on a proximity focus, completely dominating residential neighborhoods via their near and safe strategy to build a convenient hyperlocal network. In contrast, 7-Eleven Malaysia operates on a margin paradox. They command much stronger global brand equity and higher gross margins, yet this advantage is heavily offset because they suffer from exceptionally high operational expenses. This brings us directly to their operational efficiency and flow. 99 Speedmart drives growth through capital velocity, relying heavily on high volume transaction, rapid inventory turnover, and smart strategy leverage to scale up quickly. 7-Eleven, on the other hand, struggles with severe OPEX inefficiency and ongoing inability to strictly control these operating expenditures continuously diminish and erodes their bottom line net profit. Finally, let's look at the financial outcome. By mastering massive economies of scale, 99 Speedmart achieved high profitability, resulting in strong net profitability and superior returns on capital. Meanwhile, 7-Eleven is bogged down by a stagnant operational flow, characterized by sluggish cash collections and poor inventory velocity, ultimately leaving them with a vulnerable asset-heavy structure. In summary, this comparison shows us two completely different paths to market penetration. While 99 Speedmart thrives on a lean, high-velocity, low-margin model built on extremely operational efficiency, 7-Eleven struggles to capture the true value of its premium brand equity due to underlying operational and cost inefficiencies. That's complete our analysis. Thank you for listening.